Hello ladies and gentlemen, welcome to today's webinar. As you have already seen, we've started our new month and our new advanced trading strategy webinars, which will of course flip one more time the month after. Today's trading webinar, ladies and gentlemen, will give you an opportunity to master the psychology of trading, which is one of the most difficult yet underappreciated elements of learning how to trade on the financial markets, regardless of whether one is trading part-time from home or trading professionally for a living. As we've probably seen that there are many books, websites and resources discussing market trading strategies, very little has been written specifically about the psychology of trading, particularly of course for active short-term traders. Now this is what we're focusing on today. This could be of course due to the fact that most technical traders out there, such as day traders and swing traders, tend to be more mathematically orientated and therefore less interested in sorts of subjects such as psychology. Now, yet to ignore the psychology of trading, of course, will almost guarantee you failure in learning how to be a consistently profitable trader. The only time traders and investors turn for help on this particular topic is after they have been blown up their accounts and have finally hit rock bottom. However, in today's webinar, I will try to improve your trading education by explaining the key psychological emotions that you should be aware of and how to avoid the common pitfalls that investors and stock traders commonly experience while trading on the financial markets. Many recommend that new traders, in order to gain experience, they need to practice in simulated accounts, or as it's well known out there, demo accounts. While this may be beneficial to learn to spot technical patterns and entry points, it is impossible to simulate the psychological side of trades unless you're actually putting your own hard-earned money at risk. In order, ladies and gentlemen, to master the psychology of trading, a trader must work his way through hundreds of trades in order to identify his personal psychological strength and weakness. What we will take a look at today is the individual versus the group trader psychology. Now, as a market trader or investor, one is constantly fighting a battle between need to think independently and avoid the urge to fight market momentum, which is also very well known as the herd mentality. Frequently, an actual currency pair, let's say, actual currency pair pick idea can be correct, okay, yet the trade ends up losing money. Why? Because the investor, the individual, believes so strongly in the merits of the trade that he fights the powerful momentum of the market itself, which is the group. Okay. Now, this typically occurs when an investor or a trader has the correct idea to buy or sell a particular pair or an instrument, but the overall market timing was wrong. Markets only shift momentum from one direction to another when the group decides, not when the individual trader believes the reversal should occur. The market can remain irrational longer than you can remain solvent. So basically, As a momentum trader of any market, the technical trend is always your friend. Fighting against it will only result in losses over the long term. While that's said, we will focus for a little while in the 4 psychological states of emotions, those which are mostly common out there among traders. Those are greed, fear, hope, and regret. In general, there are 4 psychological states of emotions that drive most individual decision making in any market in the world. As we mentioned, those are greed, fear, hope, and regret. Since the stock market is made up of individual human beings who tend to act in similar manners, a group is formed. It is only the group's opinion that matters during the trend. But it is the individual trader's job to identify the clues as to when a market is about to shift direction. Now, this is the place where I should make a small amendment to let you all know that this month's webinars will be connected all together. So even if you miss one, it will be difficult for you when you join the next one to understand what we were talking about. So if you don't have the time to be at the webinar, at least make a request to send you the direct link, which is to our YouTube channel, so you can review the webinar you've missed before you take the next step. Now, those techniques, ladies and gentlemen, that you will see here along the month of November, as I mentioned, they're all connected, and they're quite more advanced to what we actually were learning in the past 6-7 months of webinars. So it is time for us to move ahead so we can present you those techniques in order for you to arise from your current basic situation to something more advanced. Therefore, the first webinar, as I mentioned today, should be the psychology of trading before we move to the technical point of view, because you need to grasp and to find out what kind of trader you are, what are your mistakes on the market from a psychological point of view. The clues are there, but they're delicate. An awareness and detailed understanding of those emotions, as we were talking about, greed, fear, hope, and regret, is what keeps the sharp technical trader out of trouble by providing a means to identify individual weaknesses. Shall I take a closer look at these emotions and provide examples of how they influence a trader's ability to constantly make money? The first one we will take a look at would be the greed. What is greed, ladies and gentlemen? Have you asked yourself? Greed is commonly defined as an excessive desire for money and wealth. In trading terminology, it can specifically be defined as the desire for a trade to provide an imminent and unrealistic amount of profit. This is something that I have to underline here. Imminent and unrealistic amount of profit. When greed sets in, a trader can focus on how much money they have made and how much more they could have made by staying in the trade. However, there is a major fallacy with this type of reasoning. Now, a profit is not realized until a position is closed. Until then, the trader only has a potential of profit, the aka running profit. Greed also frequently leads to ignoring sound risk management practices. All right. Now let's talk about the second one, which is fear. by far the most underestimated factor from a psychological point of view. So what is fear? Fear is defined as a distressing emotion that is caused by feeling of impending danger, which results in a survival response. Okay, this holds true regardless of whether the threat is real or imagined. Fear is probably the most powerful of all human emotions, ladies and gentlemen. When traders become afraid, they will sell a position regardless of the price. Let's say if you have a short position, of course, you will buy, so you can terminate it. Fear leads to panic. Panic leads to poor decision making. Remember, fear is a survival response. People have been known to jump off buildings during market panics, even that. By contrast, one has ever jumped off a building because of greed. Nobody's done that. It took the Dow Jones Industrial Average, let's take an example, from 1983 until 2007. It's roughly 24 years to rally from 1,000 to 14,200. But it only took 2 years to lose half of this value. Between 2007 and 2009, as we already know, the market crash around those years. What happened? That's a dramatic example of the power of fear, ladies and gentlemen. Fear is good emotion. If it gets you out of a bad trade, for example. If, for example, a currency pair pick hits its predetermined stop price and the disciplined trader exits the trade, then the fear of losing an excessive amount of money protects the trader from financial ruin. However, fear can work against a trader when they don't enter a quality setup because they have had a series of losing trades. Just because a trader has lost some money on the market in the previous trades does not mean he should be fearful of entering the next one. Okay? That's why we have trading plans, strategies, rules that we follow. Trading systems are intended to take the emotions out of trading. If you're afraid to enter a quality setup, it's no point even trading. That's a very good point here. If you're afraid, just stay away from the market. It's not for you. When the market is in a state of panic or fear, the traders should never try to rationalize or come up with excuses why they should not get out of their positions. During times of fear and panic, ladies and gentlemen, it is best to go to cash. Listening to the news, to government experts, or other traders' opinion is just a waste of time. If the market, as we mentioned, the group, is in a state of panic, for example, it is best not to fight the trend. The group always wins. You don't have enough money to hold the market up by yourself. It's pretty simple, actually. When institutional traders, let's say banks, mutual funds, hedge funds, decide to dump their positions, the market will fall. And vice versa. When there is fear, steer clear. Also, another very good example here, when in doubt, get out. Truly understanding the power of fear is one of the key pieces of the puzzle to improve your trading education, ladies and gentlemen. But enough about fear. Let's talk about hope right now. Let's talk about hope. Now, hope is a feeling. What kind of feeling? It's an expression and desire for a certain thing to happen. As we know, it's an individual's desire to want or wish for a desired event to happen as well. Hope may be the most dangerous of all human emotions when it comes to trading. You should remember that. Hope is what keeps a trader in a losing trade after it has hit the stop. Now that is why we have protective stops. Use them. If you don't use those, then you have a virtual protective stop, for example. Do not hope that the price will reverse your way. Just clear out the trade, close the position, find another trade. Greed and hope, ladies and gentlemen, are what often prevents a trader from taking profits on a winning trade. When a currency pair, for example, is going up, traders will often remain in their trades in the hope of recouping past losses. Every trader hopes that a losing trade will somehow become a winning trade. But markets are not a charity organization, ladies and gentlemen. Every trader hopes, as we mentioned, that a losing trade will become a winning trade. There's no such thing. This type of thinking is dangerous because the group, the market, could not care less about what you hope for, or what is in your best interest, for example. Rest assured, ladies and gentlemen, when your thinking slips into hope mode, the market will punish you by taking your money. Why am I so harsh right now? Talking about fear, hope, regret, nothing about the good parts of the trading? That will follow, trust me. Today's webinar, ladies and gentlemen, is only to point you what you might have done wrong in the past so you can prevent it in the future. So bad is not so bad, actually. There is always something good, something to learn from. Regret. What is regret? Regret is defined as a feeling of sadness or disappointment over something that has happened or been done, especially when it involves a loss or a missed opportunity. Now, the negative implications of these emotions are obvious, of course. It is only natural for a trader to regret taking on a losing trade or missing a win trade, for example. But what is important as a trader is not to hyper-focus on losing trades or missed opportunities. It's very important here. If you lose money on a trade, for example, then you should simply evaluate what went wrong and move forward. That's it. No regrets. Other than the lessons that can be gained from evaluating each trade, there is no point of spending future time regretting the decision to enter the trade. It is also human nature to feel that regret when an opportunity is missed. If you miss a winning trade, then you must move on to the next potential trading opportunity. There are so many currency pairs, commodities, indices, company shares, whatever you want to trade. So many opportunities. When technical traders allow regret to rule their thinking, they tend to chase trades in the hopes of still being able to make money on the position by entering it well above the trigger price. The problem with this type of thinking is that the reward risk of the trade no longer meets the parameters of good trade management. For instance, by entering a trade, let's say 1 point higher than the trigger, the potential reward may be 1 point, but the potential loss may be also 1 point. This sets the reward-risk ratio at 1 to 1. we prefer trades to have at least a 2-to-1 reward-risk ratio. Isn't that right? We have to make more than we're actually losing. Successful and profitable traders learn to discipline their mind to eliminate regretful thinking. Let's make a small summary on how to improve our trading education. As humans, it is normal to experience these 4 powerful psychological events. When trading or investing on the market, however, of course, being aware that these emotions are always right on our doorstep. And it's the first step to being disciplined enough to overcome them. When you do, you will find the results of your trading operations dramatically improved. Okay. Now, let's go a little bit deeper into the psychology of trading. We're going to break down different elements, and we will see how Forex traders have not to only compete with other traders in the Forex market, but also with themselves. Oftentimes, as a Forex trader, you will be your own worst enemy, ladies and gentlemen. We as humans are naturally emotional, okay? Our egos want to be validated. We want to prove to ourselves that we know what we are doing and we are capable of taking care of ourselves, okay? We also have a natural instinct to survive. All of these emotions and instincts can combine to provide us with trading successes every now and then. Most of the time, however, our emotions get the best of us and lead us to trading losses unless we learn to control them. Many Forex traders believe it would be ideal if you could completely divorce yourself from your emotions. Unfortunately, that is next to impossible, and some of your emotions may actually help improve your trading success. The best thing you can do for yourself is learn to understand yourself as a trader. Identify your strengths and your weaknesses, and pick a trading style that is absolutely right for you. Now, this is the part where I will mention that every time I'm on the phone with some of you guys, I've got a list of questions to find out what kind of person you are, which kind of strategy would be suitable for you, to make a suggestion. This is based on psychological events, from a psychological point of view, and also from your previous experience as a trader. If you're new on the market, I've been asking questions about your line of work, for example, what you're good at, so I can make the strategy suitable for you. As I mentioned, today's webinar is something to show you what you need to do for yourself on your own to find out who you really are on the market. In this section, you will learn about the following 4 psychological biases that may be affecting your trading results and what you can do to overcome them. We will be talking about the overconfidence bias, anchoring bias, confirmation bias, and loss aversion. The overconfidence bias is very important. The overconfident bias is an overinflated belief in your skills as a Forex trader, for example. Now, if you ever find yourself thinking to yourself that you have got everything figured out, all right, that you have nothing more to learn and money is yours for the taking in the Forex market, you probably suffer from an overcoming bias. What are the dangers of the overconfidence? The overconfident trader, for example, tends to get themselves into trouble by trading too frequently or by placing extremely large trades as they go for the home run instantly. All right. Inevitably, an overconfident trader will end up entering a trade in and out and placing positions one after another in different directions. Now this is too risky. You're risking too much on the one trade that goes bad and wipes out most of the trader's account. Okay? That's overconfidence. Now, ask yourself, for example, are you overconfident? If you want to know if you have any overconfidence tendencies, ask yourself, have I ever jumped right back into a trade I had just been stopped out of, not because I saw another entry point, but because I couldn't believe I was wrong? You can also ask yourself, have I ever put more on a trade than I normally would because I was just sure that a trade was going to be the one trade? If you have, you need to be aware of those tendencies. How to overcome the overconfidence? The best way to do that is to establish, for example, a strict set of risk management rules. Now, these rules, ladies and gentlemen, should at least cover how many trades you will allow yourself to be in at one time, how much of your account you are willing to risk on any one trade, and how much of your account are you willing to lose before you take a break from the trading and reevaluate your trading strategy. Now, a very important piece of information here, our Forex risk management strategy that we've been teaching on the basic webinars is a very good way to do that. By limiting the number of trades you are willing to be in, the amount of risk you're willing to take. So you can, of course, spread your risk out evenly over your portfolio. Okay? That's very important to remember here. If you have a problem with that, contact me. I will try to help. Now let's talk about the second bias, the anchoring one. It's a propensity to believe that the future is going to look extremely similar to the status quo. Now, when you anchor yourself too closely to the present, you fail to see the dramatic changes that are possible as a currency pair fluctuates and the underlying fundamentals shift. Now, I do believe that most of you guys never even heard of that. But why is it so important? Now, let me give you the dangers of the anchoring bias. Anchor traders tend to get themselves into trouble by convincing themselves that the current trend will never end and a reversal in the economic strength of a particular country is next to impossible. They become emotionally attached to the previous trend of a currency pair, and of course they continue to place trades that go against the new one, the current trend. With each trade, they lose more and more money because they are bucking the trend. That's what I mentioned even in the beginning. The trend is your friend until it ends. Are you anchoring yourself? If you want to know, if you have any anchoring tendencies, of course, ask yourself, have I ever lost money because I couldn't accept that the trend has ended? If you have, you need to be aware of it. You need to place a very huge rule to be aware of when the trend shifts. A very good example to how to overcome the anchoring bias. The best way to do that is to look at multiple time frames on your charts, for example. If you usually trade on the 4-hour chart, take a look at the daily chart, the weekly chart, every now and then to see where some of the long-term levels of support and resistance are and what the long-term trend looks like. You should always you should also take a look at the shorter time charts, okay, to see when the shorter time trends are reversing. Broadening your perspective will help you to avoid anchoring yourself to any one point. Now, that's something that I usually mention when you guys start asking me what time frame should I look, what time frame is best to trade. That's why you have so many time frames, so you can use a particular strategy on it, but you have always need to you know, to be aware of the bigger picture. Okay, not only the small time frames, but in the bigger picture, you need to know what direction the current trend is. Because as we mentioned, there are three types of trends, and there is nothing more than an uptrend, downtrend, and a sideways trend. There is no other direction of the market. It's so easy to understand that. So let's take a look at the third part of the content of the in-depth analysis of psychology. This is the confirmation bias. Its propensity to look only for the information that confirms the beliefs that you already have. For instance, if you have believed that the euro-dollar, for example, is going to go up, you will look for the news, the technical indicators, and the fundamental indicators that they support your belief. That's the confirmation bias. What are the dangers of seeking confirmation? Traders who overactively pursue confirmation of their beliefs tend to miss key warning signals that would normally have protected them from unnecessary losses. In an attempt to build a case for their beliefs, traders miss the fact. Ultimately, this leads to them fighting the trend and losing money with each ill-conceived trade, for example. Now, if you seek a confirmation, you want to know if you have any confirmation bias tendencies. Ask yourself, how often do I look for signs that I may be wrong in my analysis? If your answer is rarely or never, you will be a confirmation seeker. And you need to be aware of that. You need to overcome it. So how to do that? The best way to overcome the confirmation bias is to find someone or a group of people you can talk to about your trading. Now, this is something that I usually do. You know, the group seminars. We have them once every 2-3 months. Something that I'm actually, you know, due to the fact that it's quite a high interest into those seminars. You know, group of people gathering together on the internet, the way we do, sharing their experience, their fears, everything about the market. I've made it as a new topic for the webinar. So basically, at the end of the month, we will have a group question and answering seminar webinar. So, as we mentioned, you can talk about your trading with someone or a group of people. Doesn't matter if that's me or someone else. You can always do that to overcome your confirmation bias. Hopefully, the person or people you talk about your trading with will not always agree with you. All right, that's very important. Talking with traders with diverse perspectives and ideas will, of course, help you look at your trades from multiple angles. That's extremely important. Sometimes you will strengthen your conviction by talking with other traders. Other times, talking with your trading partners will cause you to change your mind. However, the important thing is to keep an open mind that will help you catch new moves and avoid holding on too long to past beliefs. You see, everything is connected. Absolutely everything. One after another, the way I've structured today's psychological psychology of trading is connected one topic to another. Now let's talk about the final piece of today's content of this in-depth psychological. We will be talking about the loss aversion bias. It's an extremely important thing as well. Loss aversion bias is based on the theory that the pain that is caused by losing, for example, $1,000 is greater than the joy that comes with gaining $1,000. In other words, fear is a more powerful motivator than greed. All right. The dangers of the loss aversion. Traders who fear losses are much more likely to hold on into losing positions than traders who are able to accept short-term losses and move on to other, more profitable trades. Okay. Holding on to losing positions jeopardizes the stability of your portfolio by not only incurring losses, but also keeping you out of better trades. So that's a very important thing to overcome. If you fear losses, and if you want to know if you have any loss aversion tendencies, ask yourself, have I ever held onto a losing trade past the point where I knew I should have gotten out because I hoped the instrument would turn around and wipe out my losses? Now, if you have indeed, you should be aware and you should overcome it. How? The best way to do that is to trade with physically set stop loss orders, the so-called stop losses. If you cannot maintain it by yourself, if you cannot get out of the trade because you strictly have your stop loss at a point of where you should get out, you should use physical stop losses or the stop losses that you can place on the charts. Now, many traders tell themselves that they will trade with a mental stop loss, is what I mentioned. A stop loss level they think about and promise themselves they will act on it if the currency pair or any instrument ever reach it. All too often, however, traders fail to act on their mental stop loss. They let their emotions get in the way and they start retaliating their choice to stay in the trade until it turns around. As soon as you enter a trade, you should set up your stop loss order. Take your emotions out of the picture. This is the only way to overcome the loss aversion. Well, all too good. Thank you for being here. This is everything about today's psychology of trading. It's not too long. Now, something that I would like to mention to all of you guys, if any questions appear from today's webinar, as I mentioned, you can either do it on our emails, support team, or directly to myself. as I mentioned, question and answering session will be at the end of the month, because everything that we will do is connected to each other. So basically, whatever questions you might have, you need to answer them at the end of the whole structure of the webinars of this month. The way we have built the webinars one after another will teach you how to build on a strategy, and at the end to use something extremely simple. Maybe some of you know how to do it, but something, an indicator that will show you which particular strategy to use in a particular situation. And, that's why we have built it one after another, and it's connected. So whatever questions you might have, send them to my email or to our support department. They will approach me with the appropriate way, and of course I'll get back to you. So far for the psychology of trading, I will be very happy if you participate at the end of the month on the QA seminar, not only for the trading strategies that will follow from this Friday and forth, but also about your tendencies, your psychological problems that you might have that stops you from being profitable on the market. Thank you guys for joining. That's all for today. I'll see you on Friday. Thanks a lot. Bye-bye.